Welcome to Standard & Poor's June Loan Market Overview clip. I'm Steve Miller, a member of S&P's Leverage Commentary and Data team, a unit of S&P that's not affiliated with a rating agency. For the next 5 minutes or so, I'll walk you through a review of recent loan market trends before winding up with some themes to watch for in the month ahead. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. You've all seen this before. It's a disclaimer that's long and detailed. Please read it at your leisure. Now to the market overview. The heat came off the loan market in May. The S&P LSTA index lost 2.2%, ending its successive streak of positive months at 16. Still, it was a heck of a ride, with the index up 61% between January 2009 and April 2010. The loan market tripped on several banana peels in May. The first, of course, was the broader sovereign debt correction that sent many investors fleeing risk assets, including loans. The second was the knock-on effects from the high-yield market, where volume plunged, and more to the point, bond-for-loan takeout activity cooled. Lastly, a spate of new issues in concert with slowing repayments helped put the market into better balance and ease some pressure on CLOs and other loan accounts to put money to work. Despite poor technical conditions, market fundamentals continued to improve in May, as reflected by sliding default and distress rates. Looking ahead, the calendar of new loan issues stands at a post-Lehman bankruptcy high. With technicals weaker, the primary market is in price discovery mode, with spreads pushing higher. Pressured by the PIIGS crisis and technical pressure, loans traded lower in May. LCD's flow name composite, shown here, is a sample of the 15 largest names in the market. The composite traded off 4% last month to around 91.25. This chart shows the return by month of the S&P LSTA loan index. As mentioned before, the index dropped 2.2% in May. Still, it remains up 4% for the first 5 months of the year. That compares to a gain of 3% for high yield and a loss of the S&P 500. As this next chart demonstrates, new issue volume remains strong in May. And with bond for loan takeout activity down, the loan repayment train slowed. As a result, the universe of institutional loans expanded by about $1.5 billion in May, the first increase of 2010. That follows an average contraction of $6 billion a month between January and April. The change in technical direction set the stage for what many participants are calling a buyer strike. Loan accounts are husbanding their cash and selectively selling seasoned paper to make room for the bulging calendar of new issues, which now stands at a post-Lehman bankruptcy high of $21 billion. Market fundamentals continued to improve in May. During the month, there was just one new loan default, NEF rental. As a result, the lagging 12-month default rate continued to ease, dropping to a year-and-a-half low of 4.6% from 5.6% in April. Improving cash flow was largely behind the improvement, accounts say. Indeed, in the first quarter, year-over-year EBITDA expanded another 10% among publicly filing S&P LSTA index issuers. The consensus view among loan portfolio managers is that the default rate will drop to about 4% by year-end, assuming, of course, the economy avoids a indelible dip. Though after the roller coaster ride of the past month in the stock market, economic growth seems far more fragile now. To wrap up, then, some final points. First, the loan market clearly weakened in May in response to the PIIGS-related tremors and technical pressures. Still, it continues to outperform other risk assets. Looking ahead, most participants think loans will track the stock market until stability returns to the system. That could make for a choppy summer. The new issue market has clearly grown more expensive and selective. Since May 1st, arrangers have flexed higher the yield of 3 times as many new issues as they flexed lower. That's reversing the ratio of January through April when the market was on fire. Also, there have been no fewer than 5 loans shelved over the past month due to market conditions. Looking ahead, better-rated loans remain in high demand, but lower-rated issues will require strong credit and pricing story to clear in this environment. As this suggests, the buyer strike I mentioned before is ongoing, with accounts keeping their powder dry for deeper secondary discounts and higher-yielding new issues. Finally, default rates are likely to push lower in the months ahead, what with a percent of loans rated CCC or lower now at an 18-month low of 5%, and just 5% of performing loans trading at severely distressed levels, down from 2009's average of 31%. That brings us to the end of our overview. I hope you found it informative. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video below. please visit us. We plan to update this video analysis monthly, and we'll have other videos as well.